believe that a default could lead to a domino effect in the bond markets, potentially damaging financial institutions all over the world. And welcome to another edition of Wealthy and Wise Wednesdays, my weekly podcast where I share a few words of financial wisdom to help put you back in the driver's seat of your financial future. Today is Wednesday, September 22nd. Thanks for joining me on this week's podcast. Today we're going to do a market update because there's a lot of things going on right now. So I have our market update pulled up here on my computer screen. So I want to share some data with you here, some current events, and then also go through a few charts. Again, just for your financial education. Nothing that I talk about here on this podcast should be construed as personalized financial advice or a recommendation to buy or sell any securities. I just want to be able to educate and help you make more informed decisions in your financial lives. So this past week, equity markets were mixed and macroeconomic indicators were also mixed. Now, manufacturing data and retail sales, that data did impress analysts, returned readings above the consensus expectations. So that's a good thing. Now, industrial production, consumer sentiment, both of those things disappointed with readings well below expectations. Now, there's another potential problem that is emerging here, and it caused a lot of havoc in the markets on Monday. There is a large Chinese property developer named Evergrande, or maybe Evergrande. I don't know how to pronounce it. Probably Evergrande. They're threatening to unsettle the debt markets and potentially threatening the Chinese economy. Today, everything is so connected globally that it's difficult to assess the potential damage or the potential impact of failure of this company, their failure to pay their debts. And a plan from Chinese government or the Chinese authorities, nothing's been announced. So some analysts believe that a default could lead to a domino effect in the bond markets, potentially damaging financial institutions all over the world. Now, in spite of current concerns, overall, the economy is well positioned to continue recovering from pandemic lockdowns. But we have a lot of challenges. We have inflation risks. We have labor challenges and labor shortages, limited production capacity. Those are all eating into productivity. We're seeing supply chains disrupted. And in addition to all of these macroeconomic factors, we have high COVID infection rates. And so that could also lead to slowing economic progress as well. Now, overseas, just as an overview, developed markets, they outperformed emerging markets, both indices returning negative performance, though. European indices were negative. Japanese markets actually returned positive performance for the week. Now, look, improving prospects against the pandemic, as well as improved prospects for recovery, that should continue to help lift these markets globally over time. Now here, equity markets were mixed this week as investors are continuing to assess the state of not just the U.S. economy, but the global economy. There are still fears concerning global stability, health. Overall, those things do appear to be in slight decline, though. Now, the recent volatility in the markets, like on Monday, we really had a rough day when this news of this Evergrande started really filtering in there. The markets were down. Pretty close, down 3% in one day, but they kind of rallied at the end of the day to finish down about 1.5%. And they've really started to bounce back this week. So that's good news. Okay. But all of this recent volatility serves as a great reminder to why it is so important to remain committed to a long-term plan and to maintain a well-diversified portfolio. Because remember, when stocks struggle to gain traction, there are other asset classes such as gold, real estate investment trust, U.S. Treasury bonds. There are other things that can prove to be more stable. And maybe those should be part of your portfolio. Again, this is just education. Don't go out and make any changes based on what I'm saying here today. Work with a financial professional who will analyze your situation and give you personalized advice. Okay. If you don't have somebody to help you out with that and you would like that, I can always help you. Retirement Wealth Advisors, that's our planning firm. And we use Brookstone Capital Management as our investment management team. So we've really got a lot of great people. Brookstone Capital, we've actually been named the #1 fastest growing RIA in the country. So that's really exciting. So if you need somebody, we're definitely here to help, and we are taking on new clients. Anyways, just a reminder, there are flashy news headlines every day. Don't make any knee-jerk decisions. You want to stick to a long-term strategy. You want to maintain a portfolio that's consistent with your goals and your risk tolerance and your time horizon. And by doing that, it could potentially lead to smoother returns and a better probability of long-term success. Now, that's not to say hey, things are happening. Let's review this plan. Let's make some tweaks. I mean, I certainly recommend to review when times start to get volatile and things look tough. But I'm just saying, don't make any knee-jerk reactions that are not consistent or in alignment with your personal philosophy about financial planning and about money. Let's take a look at the chart of the week here. I want to go ahead and just do a screen share. Okay, so on your screen right now, you're going to see what we're calling our chart of the week. And you're going to see that U.S. consumer sentiment remains depressed and buying conditions are really slipping. And you're going to see on this bottom half right here, we're looking at buying conditions for household durables, buying conditions for homes, buying conditions for vehicles. And you can see on your screen that during 2020, it really plummeted, of course, with the coronavirus, but then it started to come back and it remained pretty steady. But now in the middle of 2021, things are really crashing again. People have a lot of concerns about what's happening in the world, tensions around the world, also here with the political scene in the United States, disruption of supply chains, really high inflation. So those are all things that are really affecting consumer sentiment right now. And it is a little bit alarming. I mean, the stock market, it doesn't move on a short-term basis guided by fundamentals. The market is made up of humans, of people, and humans are emotional creatures. And when we have negative consumer sentiment, that can potentially have some impact on the market in the short term. So that's just one of those things that we do want to keep an eye on. So that's our chart of the week with consumer sentiment. It has not improved. It continues to sag. It reveals poor buying conditions for many of these big ticket consumer items that we just looked at. Again, homes, vehicles, household durables, they've reached a sentiment level, a negative sentiment level, or a decline, I should say, that hasn't been seen in decades. Now, let's take a look at a United States market update with markets here locally, or I should say domestically in the United States, with the equities market. So broad market equities, they finished the week mixed. We had major large cap indices underperforming small cap. So small cap did a little better. S&P sectors were mostly negative over the last week. Energy and consumer discretionaries outperformed. Energy returned 3.31. Energy has regained the lead in 2021, and now we're up for 29%. Utilities and materials underperformed, where they posted negative 3.11 and negative 3.22 respectively. So I want to, just be able to bring up this next chart here again. Now let's go over. You can see this chart again, energy up 3.31% for the week, consumer up about 0.5%, and pretty much everything else was negative. So financials and real estate have kind of been battling with energy over the last few months as far as what would be the lead sector for the year. And recently, real estate had pulled into first place, but it's pulled back a little bit, and energy has surged forward. So again, energy is up 29% for the year, followed very closely by real estate, which is up 28% for the year. Financials up almost 27% for the year, and communications up 26% for the year. So doing very strong for the year. And again, that's what you want to keep in mind. Over the short term, we can have 2 or 3% drops in the market in a day. But year to date, we've had really, really great performance overall in the market. and especially with some of these certain sectors. And if we kind of take a look at these different sectors, the S&P 500 benchmark, the Dow Jones Industrial Average, the Russell 2000, developed markets internationally, commodities, aggregate bonds, U.S. Treasury bonds, and high yield bonds. You're going to see, I'm going to look at that. I guess it's the fifth column over from the left, the year to date performance. The S&P 500 up over 19%. The Dow Jones is up 14.5%. Russell 2000 up 14%. Developed markets up 11%, and commodities up 33.5%. Then you're going to see bonds aren't doing so well, with the inflation and interest rates. But the high yield bonds, sometimes called junk bonds, high yield bonds up 4.19%. So there you have it. That's kind of the performance of the markets here today, or here this last week, and where we're at today over the course of the year. Now let's talk about commodities, because they have been outperforming. Oil this week, it rose as crude oil inventories, they shrunk more than expected. Energy markets, it's been highly volatile in the COVID era, but it appears that higher oil prices may be more of a norm given the recent market fundamentals. Demand is still low compared to early 2020 before the coronavirus hit, but as global economies are continuing to improve, oil consumption is recovering rapidly. Now, on the supply side, operating oil rigs still well under the early 2020 numbers, but starting to trend upwards. In addition to supply and demand, a volatile dollar is likely to have a large impact on commodity prices. Looks like we got a big truck passing by right here. I wonder if you guys can hear that on this podcast. Hilarious. All right. So as this truck passed, let's talk about gold as a commodity. Gold fell this week as the U.S. dollar strengthened. So gold is a common type of safe haven asset where it rises during times of market stress. So the focus for gold has shifted a little bit there. It's shifted again to include not just global macroeconomics surrounding the COVID-19 damage and recovery efforts, but also inflation and its possible impact on the value of the U.S. dollar. Moving over to bonds now, yields on the 10-year Treasury, they rose this week from 1.34 to 1.36, while traditional bond indices fell. Now, Treasury yield movement, they reflect general risk outlook. They tend to track overall investor sentiment. So expected increases in future inflation risk have helped elevate yields since the pandemic era lows in interest rates. So Treasury yields will continue to be a focus as analysts watch for signs of changing market conditions. High yield bonds, as we just shown, they rose this week. They're performing fairly well. They rose this week as the spreads tightened. And high yield bonds, they're likely to remain more stable in the short to intermediate term as the Fed has adopted a remarkably accommodative monetary stance as these major economic risk factors subside. So that'll likely help to stabilize the volatility in some of these high yield bonds. Now, a potential headwind could be on the horizon. So I want to just bring that to your attention, because the Fed has expressed that the purchase of assets could be tapered down in late 2021, which could raise yields. Okay. All right. So we're going to move on here for this week's report, and we're going to head toward the conclusion here. So our quote of the week, the lesson to be learned. This is from Shelby M.C. Davis. Words of wisdom: invest for the long haul. Don't get too greedy. Don't get too scared. Look, it can be easy to become distracted for our long-term goals and chase returns where markets are unstable, where they're volatile. And it's because of the allure of these distractions that having a plan and remaining disciplined is mission critical for long-term success. Focusing on the long run can help minimize the negative impact that emotions can play on your performance, or the drag on performance of your portfolio over the long term. So sticking to your plan can certainly help increase your chances of success over time. So on tap for this week ahead, this week sees updates to housing indicators and PMI numbers, as well as a scheduled Fed rate statement and press conference. More to come. Stay tuned.